Okay, I guess we should start now. So my name is Hannah. I'm going to be your lecturer and the chief examiner for BFF 5925. And for this unit, I'm going to teach with Dr. Zhongyan Zhu. So basically, I'm going to be here for the first 4 weeks, and I'm going to see you back in week 12. And we are going to talk about the last lecture and the final exam. And you will see Zhongyan from week 5 to week 11. Okay? Nevertheless, I'm always available for consultation. So every week, if you want to see me, I'm available from 3 to 5 p.m. And you can see the details of the consultation and the venue on Moodle. Okay, so even though I'm not teaching for 12 weeks, but I'm going to be available for consultation. So if you need me, you can see me every week if you want to. Okay? So basically, for this unit, we are going to use Perino's textbook. So if you haven't got it yet, you should go and get the textbook. So I don't really mind if you want to use your printed text. If you want to buy the textbook, the physical copy, you can do that. But if you want to buy the e-text, it is available on Wiley Direct as well. It's up to you. Whatever way you are comfortable with, you can just go with the textbook. And also, all of the materials will be uploaded on Moodle. So make sure that you check Moodle every week. And then I'm going to send you different announcement during the semester as well. So make sure that you check your student email account all the time. And then you should see important announcement. So basically, I'm going to send you a reminder regarding your online test, regarding your mid-semester test, and I give you the details of what is expected. So everything is communicated via email, okay? So this is the structure of every seminar. So you know that we have 3-hour seminar every week. So basically, the first hour will be spent on the tutorial. So the tutorial will be based on the materials of the topic from the previous week. So this is week 1, so it is not applicable. So I sent you the email earlier, and I said that this is going to be 3-hour seminar. But from next week, there will be 1-hour tutorial and then 2-hour lecture. Does it make sense? So the first tutorial will be on, the first hour will be on the tutorial for week 1, and the last 2 hours will be for your lecture for topic 2. Okay? And it is the expectation. So we expect you to read the lecture slides before you go to the class, so at least you have an idea of what I'm going to talk about. And as you can see for this lecture, we are going to cover 4 chapters in 1 lecture. So if you haven't read that in advance, you may feel that I'm going a bit too fast, right? So you have to somehow prepare it, and then after the lecture, you can review it. And then if there is any question, feel free to send me an email to see me in my consultation. Okay. And regarding the tutorial, I'm going to upload the solution of your tutorial every week. So the purpose is for you to understand. So in the class, we are trying to work through the tutorial questions, but you are not under any pressure to write down the solution because it will be available for you after the lecture. So basically, after our lecture today, you can see the solution if there is any tutorial question. Does it make sense? Okay. So you just need to discuss with your friends and talk to me, and then we are trying to cover and to understand all of the materials in class rather than trying to copy down. So that's the purpose. Okay, so all of the information regarding your unit is included in the unit guide, and the unit guide is available on Moodle. So here, just a summary of the assessment for this unit. So for this unit, there will be 2 online tests. The first one is in week 6, and the second one is week 11. So I'm going to remind you when it comes closer to the date. But basically, each online test will be 5%. And then there is a mid-semester test in week 8, and it is 20%. So in week 8, you will do the test first, and then there will be the lecture after that. Okay? So still there is a lecture after your test, because the test is not going to be 3 hours, of course, right? So I'm going to give you more details regarding the structure and the format of the test. And the final exam is 70%. So there are some housekeeping rules that I would like you to follow in class, just to show your respect to me and to your friends. So basically, just remember to keep your phone silent when you are in class, and if you really need to take your phone call, feel free to get out of the room and then take the phone call, and then you can come back, right? And I will give you lots of chance to have a discussion in class. So basically, you don't need to talk when I'm talking. And basically, I will give you a chance to talk, and then I will be silent. So you are not going to listen to me for the next 3 hours continuously. I don't think anyone can stay awake after 3 hours listening, right? So I'm not expecting that. Basically, I give you some breaks in the middle and also discussion in the middle just to give you feel a bit more energetic. And regarding the hours, we are going to start at 9:05 every Friday, so make sure that you are on time. And if there is any question, as I said, I'm here to help you, and I'm happy to take any question. So you can interrupt me in class if you want to. You can talk to me after class, you can talk to me during consultation, or you can send me an email. So don't leave that till the last minute. So basically, for this unit, every topic is connected. So make sure that you don't miss any single topic. If it just happens that you don't understand any point, you can refer back to the lecture recording, which will be available after our seminar today. And then you can listen to that again. If you still don't understand, go to see me during my consultation. So don't leave it to the last minute. So I tell my students so many times last year as well that during the final exam consultation or before the mid-semester test, so we had consultation and there were a queue of 20, 30 students. And basically at that point in time, each of you can only take 5 minutes of my consultation time, right? It's not going to be enough. Whereas in the first several weeks, I was there and then no one turned up. And basically you wasted that several hours that I was there and available for consultation. And if you turn up at that time, you could have taken 2 hours of my time easily, rather than 5 minutes when you really need it, right? So make sure that you ask me whenever you have any question, and there is no stupid question, okay? So don't feel like you are asking a stupid question, because if you know everything, you would not be here today. So I would not expect you to answer correctly every time when I ask you in class, but I want you to answer it correctly when it comes to the test and the exam, okay? Okay, so there is a hurdle requirement that you should be aware of for this unit. So in order to pass the unit, you need to achieve at least 50% overall and at least 50% of your final exam. So that is what it means by hurdle requirement. So in order to pass the unit, you need to pass the exam and you need to achieve at least 50% of the overall unit, okay? And in terms of the calculator policy, I'm not sure whether you all obtain that, but it is the calculator that we are going to use, and it is the only calculator that will be accepted in your test and your final exam. And as a Monash Business School student, you are given one calculator like this. So if you haven't collected that, go to Building N, Level 4, and see the student services to collect your calculator, okay? And please remember to bring it to class every single seminar, because we are going to use your calculator every seminar. So don't try to use your normal calculator because it's not accepted in your final exam and your test. So even though you are comfortable with that, you need to learn how to use this calculator. Okay, if for some reason you miss any of the assessment, including online test, mid-semester test, and even final exam, so please check carefully the link regarding special consideration. So if you are eligible to apply, you can refer to the eligibility there. So if you are eligible to apply, you need to send your application to me within 48 hours, okay? So basically, that's all I need to say regarding the administration of the unit. So is there any question that you would like to ask? Everything is clear? Everything is good? Okay, so feel free to ask any question if it bothers you. Okay, so for today's lecture, we are going to talk about corporate finance, and we are going to talk about financial mathematics. So in the first half of the lecture or the seminar, we are going to talk about corporate finance to make you understand what we are going to learn over the 12 weeks of the semester. And then we spend the second half of the seminar on the financial mathematics, where I will introduce to you time value of money, how to calculate present value, future value of different cash flow patterns. So for this lecture, we are going to refer to chapters 1, 2, 5, and 6, so 4 chapters in your textbook. So as I mentioned, there will be 2 parts, corporate finance and financial maths. Okay. Basic concepts of corporate finance. So we are going to look at what is corporate finance and what are the financial managers and what are their roles. And we are going to look at the goals of financial management, and we are going to discuss the agency issues and the role of financial markets. So that is our first half of the seminar. Okay, so what is corporate finance? So we are learning financial management theory, and the main concepts covered in financial management theory is related to corporate finance. So here, corporate finance is the study of ways to answer 3 important questions from the perspectives of corporation. So we are talking about 3 decisions here. We are talking about investment decision, we are talking about financing decision, and we are talking about payout decision. So just refer back to the balance sheet of any corporation that we've learned, or you might have learned in your bachelor degree, or you might have known from your reading. So just think about the balance sheet. So if you are thinking of the balance sheet of any firm, there will be assets, of course, right? And there will be liabilities and equity, right? So assets, liabilities, and equities. Let me give you an example for those of you who haven't got any background in accounting and finance. So assuming now that you are having the mouse, okay? Assuming that you have that mouse here, and it was $60. Is it your asset, your liability, or your equity? Your asset, right? So your asset is the mouse, and the mouse worth $60. So in order to know the liability or the source of fund to buy that asset, we need to know how much of that $60 come from your own saving. Let's say that you work hard, you work part-time, and you have part-time job. You earn $30. So that $30 was spent for buying for that mouse purchase. So the $30 that you worked hard and then you earn is considered your liability or equity? Equity, that's your own savings. That's how much you get from your own effort, right? So basically the asset is $60 of the mouse, and the liability is $30, and the equity will be $30, okay? Just let me put it back here. So the mouse is $60, you work hard and you save $30 to be able to buy that mouse. It means that you need an extra $30 to buy the mouse, right? How to get it? Borrow. So you can borrow from your parents, you can borrow from your siblings, you can borrow from your friends, and you get another $30 to buy it. So basically it is a source of fund that we use to be able to finance our asset. Does it make sense? So there is another $30 here. So what can we learn from it? Asset is equal to liability plus equity, okay? So that is for a personal balance sheet. For a firm, it is going to be much more complicated, right? It's not going to be one asset, one liability, and one equity. So for a firm, how is it going to be different? Can you think of some asset? Just some example, okay? I'm going to make it a bit bigger up here. So normally we would say asset, liability plus equity. And now if you need to list different components of the asset of the firm, What can you think of? Let's say that if you own the firm, what would be the assets of your firm? Very obvious. Can someone just be a bit louder so I can hear? Cash, right? You need to have cash to be able to finance any day-to-day transaction. So the firm will have cash as well, right? And the firm will have financial asset. If the firm decided to invest into any financial assets, so the financial assets will be a part of the assets that the firm is holding. So when I'm talking about financial assets, I really mean bonds and shares and different derivatives. So we are going to spend time on those financial assets. Okay? So for now, just understand that the firm can invest in financial assets, and the firm can also invest in real assets. That's how the firm survive. They will invest in the real assets. So by saying real asset, you can think of, let's say, Apple. So Apple actually produce or manufacture the phone or iPhone or iPads. They are real assets. They are not financial assets, right? So they are a part of the assets that the firm is having. So we are talking about financial asset. We are talking about real assets. Okay? And of course, you can think of other assets as well, including just other property or equipment that the firm is having, right? So that they are all of the assets that the firm is having. So how about the liability and equity? So as I said to you, the firm can borrow, right? It's the liabilities. So we just say borrowing or debts, the same thing. And as I said earlier, the firm can borrow from the bank, definitely. The firms can borrow from the banks. Can borrow from financial institutions, that's right, or non-bank financial institutions. Who else? From other firms, right? They can borrow from other firms. So you can think of any subjects that the firms are borrowing, so any other firms. Other firms can borrow from the suppliers. So basically, they can just buy the input and then owe for a couple of months. It's also a borrowing. So we are talking about different borrowings that the firm is having. And then we have equity. Okay. So the top part, the borrowing, is the same as debt and the same as liabilities. And then we are talking about equity. So equity is represented by, do you know? Just start with, let me make it easier. So we have bonds and shares. Which one is debt instrument? Bonds or shares? Bonds, that's correct. So by saying that it is a debt instrument, it's the same as it is a representation of borrowing. So if I'm the firm, I'm issuing the bonds to you as the investor. It means that I owe you the amount of the face value that I put on the bond. So for example, I issue $1 million worth of bonds, and then you as the investors, you decided to buy that $1 million value of bonds. Right? It means that you lend $1 million to the firm, to the issuer. Make sense? So in the future, no matter whether the firm or my firm is profitable or not, I still have the obligation to pay you back $1 million. Whereas if I issue the shares to you, I'm as the firm and you as the investor, and in the future, if the firm is profitable, you as the shareholders will get a lot and it is based on the dividends that you are going to receive, or it is based on the capital gains that you are going to earn when you sell the shares again. But if my firm is not profitable, as the shareholders, you may lose everything. There is no commitment that the firm is going to repay the shareholders. Is it clear? Okay, so understand that debt instrument or bonds would be a part of the borrowings. And borrowing means that the owner or the investor is the debtor or the creditor of the firm. Whereas if you buy the shares of the firm, you become the shareholders. And the shareholders are the owners of the firm. If the firm is profitable, the shareholders will be profitable. If the firm is not profitable, the shareholders may lose everything. Okay? So we will spend a bit more time and talk about debt instrument and equity instrument, just to make it really clear to you whether when you buy the debt instrument or you buy the equity instrument, you will become the investor or the debt holders or the equity holder. Okay? So how is it related to our question here? So here we are talking about 3 questions in corporate finance. If you look at that, investment decision, financing decision, and payout decision. So we start with the first one, investment decision. It is related to which side of the balance sheet? What do you think? The asset, right? So as the firm, as the financial manager of the firm, you need to be able to identify the profitable investment for the firm. So there will be many investment opportunities available in the market. And we need to choose which one is the best for our firms, including financial asset investment, including real asset investment. And that's why we are going to learn how to be able to value the shares and the bonds, to be able to identify whether it is profitable to buy those shares or those bonds. And we are also learning the capital budgeting to know whether it is profitable for us to invest into that project or not. Okay? So our first decision, investment decision, is related to the asset side. So here you can see the investment decision starts with the identification of investment opportunities. So we want to know which opportunity is profitable. Okay? So that's our first question. The second question that we are looking at would be financing decision. Okay? So when we are talking about financing decision, we want to know what would be the optimal combination of borrowing and equity. Let me make that question a bit clearer. If you are the firm manager, okay, and if you only care about profit, should you use the equity or borrowings to finance the asset? Borrowings, why is that? Because it is cheaper, right? Okay? So if you think about that, we explained earlier that if you are the debt holder, or if you are the creditor of the firm, and if you have to compare with the shareholders of the firm, who take more risk by investing into that firm? The shareholders or the debt holders? The shareholders will take more risks, right? Because basically, if you invest into the firm as the shareholders, you may be able to get your money back and get lots of money back, and you may be able to get nothing back. Agree? Whereas if you are the debt holder of the firm, if the firm is profitable, you get that fixed amount. If the firm is not profitable, you get that fixed amount as well. Right? So of course the bondholders will take less risk compared to the shareholders. So now, if my firm wants you to invest into the firm that I'm having now, and I ask you, I'm going to pay the debt holder 8%. Okay? So in order for my firm to be able to attract you and invest into my firm as the shareholders, would you be happy if I pay you 7%? Of course not, right? You are taking more risk. You would not be able to ask for less return. You have to ask for higher return. So basically, you will ask for higher than 8%. But how high is it? It depends on your assessment of the riskiness of my firm. Does it make sense? But at least you, as the shareholder, will be required to have higher return than the debt holder. Okay? And in that sense, here we are saying that debt is a cheaper source of fund compared to equity or compared to shares. And because of that, if we just follow our profit maximization goal, we are going to borrow as much as we can. Because if we borrow a lot, we are going to save the expense and we are going to have higher profit. Okay? So if we only care about profit, all of the firms should just borrow. Okay? My next question is, why do you still see that in the balance sheet, there's still equity and liability? Because if every firm should borrow to the maximum that it can, should it just be 100% borrowing and no equity? What is the trade-off here? And we are going to talk about that all the time in finance. There is a trade-off between risk and return, right? So if your firm decided to borrow a lot, is it safe or is it risky? It's risky. Let me prove to you how risky it can be, okay? So assume that we have two firms, firm A and firm B, and they plan to finance the same set of assets. So they have identical asset portfolio, okay, identical, and it is 100. Okay, they're exactly the same, so I'm not going to list the components, but they are the same. The only difference is that firm A, debt is 80, equity is 20. Okay, firm B, debt is 30, equity is 70. Okay, so the total is still 100. The only difference here is the structure of the capital structure. Okay, the difference in the capital structure of the two firms. One is having a bit more debt, the other one is having more equity. So we agree that by having more debt, the expense will be lower because debt is a cheaper source of fund compared to equity. You with me? But now we see whether it is safe to do so, whether it is safe to borrow up to 100%. So now we are looking at our investment. We know that when we make an investment, if we are lucky and if we are smart enough, our investment will generate income, right? However, sometimes our investment may not be that lucky. So assuming that the firm invests everything into financial assets, and the firm decided to buy the shares of a company. So when the firm bought the shares, those shares worth $100. But you know that the share price fluctuates every day in the market, every moment, every second, every millisecond, right? So the share price can go up, it can go down. And assuming that the share price was going down, and the value of your portfolio is not $100 anymore, it becomes $50. Okay? And as I mentioned earlier, those assets are identical, so the value of the assets of both firms dropped to $50. What is going to happen? If you look at firm A, now the value of the asset is $50. Who will bear the loss first? The shareholders or the debt holders? Shareholders will bear the loss first, right? And here we lost $50. But the shareholders can only bear $20, right? And that firm will go bankrupt because basically they have negative equity, negative 30, right? So the firm will go bankrupt. Does it make sense? So that firm will no longer exist. Now we are looking at firm B. After a $50 drop on the asset side, and you know that on the liability and equity side, the shareholders will need to bear the loss. Instead of having 70 now, it will become 20. right? It will become 20 because our asset is always the same as liability plus equity. So now the equity value is only $20. Of course, there is a loss of $50 here, but that firm still exists. And hopefully after another month, that asset investment or asset portfolio will go up again, and maybe it becomes 150, right? So here we are saying that by borrowing a lot, it's going to be more profitable, but then the firm becomes riskier. So this is risk and return trade-off, okay? And the question that we are going to deal with in this unit is, how much should we borrow? And how much should we generate in terms of equity? So as the financial manager, we need to know the optimum point where we can achieve the highest benefit of borrowing without taking too much risk. So that's the second question that we ask, okay? So this is a financing decision. So we want to know the optimal combination of debt and equity by looking at all of the disadvantages and advantages of borrowing, okay? So this is one of the lectures that we are going to look at in this unit. Okay, so the final question that we are looking at in this unit is the payout decision. So the payout decision is related to equity. So we try to answer the question of how much of the profit should be retained and how much should be paid out in dividends. Okay? So let me give you an example here. So we are going to spend a bit of time on the income statement in week 4. But for now, just to recall the memory of the income statement that you may have in the past. But if you haven't had it yet, it's fine, because I'm going to repeat that. So if you are looking at the income statement, just put it clearly here. Income statement or profit and loss statement is the same thing. Wow, something wrong with that. Okay. So if you're thinking of the income statement, we start with the revenue, and we minus all of the expenses. And we have earning before interest, tax, depreciation, and amortization. Right. Revenue minus expense will give us EBITDA. Earning before interest, tax, depreciation, and amortization. So after we deduct the depreciation and amortization, we are going to have EBIT, earning before interest and tax. And after we deduct interest, we are going to have earning before tax. And we deduct tax, we are going to have net income. Right. Who does the net income belong to? Who is the owner of the net income? Shareholders, right? So there will be a question. So if you know that the shareholders will become the owner of the net income, and you are the shareholders of the firm, now you have two options. The first option is you take all of the net income. And if you take all of the net income, there would be no reinvestment. Agree? Because normally we need to generate the income, and then we use that to keep investing and generating more income in the future. So if you take a lot of the net income as dividend, there will be less to reinvest and less to be created in the future. So now there is a trade-off between whether we need the cash flow today or we need the cash flow in the future. And how much should be enough for us to be able to sacrifice the dividends today, to be able to generate more cash flow in the future. And it is a question of payout policy, because the net income that we are having here will be divided into two parts. The first part would be the dividend. Okay. The firm may decide to pay 60% dividend, and the rest will be retained earnings. Okay? And the retained earnings will be used for reinvestment and to make more profit in the future. And of course, if the firm can make more profit in the future, there will be more dividends to be paid in the future to the shareholders, right? So this is, of course, a trade-off again between the time. So as the firm manager, you need to know what would be the optimum payout policy, or what would be the optimum dividends payout that you are going to pay to your shareholders, and how much should the firm keep as the retained earnings. Okay? So this is the third question that we are asking. And if there is retained earnings here, in which part of the balance sheet should I add it back to? What do you think? So retained earnings belong to the shareholders, right? So where should I add it back to? The equity, thank you. All right, it should be the equity. Okay. So there are the three questions that we are going to look at in different topics of the unit. And it is the simplified company organization chart. So this figure is adapted from your textbook, and then you can see different titles and different people who are involved in the company organization. And just have a look at this here. So I'm going to focus on the financial manager. So just see it here. So you see that we are going just to focus on the CFO, the Chief Financial Officer, and we are going to look at the treasurer and the controller. So financial manager can be defined as someone responsible for a significant corporate investment or financing decision, because we are working on corporate finance, so we only focus on the financial manager here. Okay? So treasurer is responsible for financing cash management and relationship with banks and other financial institutions. So that is the responsibility of the treasurer. And controllers have responsibilities for budgeting, accounting, and tax. So I think you should know that. And the CFO supervises the treasurer and the controller. Okay, so very simple. Okay, so what are the roles of the financial manager? So it is similar to the questions that we've been looking at of the corporate finance. So they are dealing with the three questions: the investment question, the financing question, and the payout question. So what asset should be bought? Right? That's the investment decision. How do we fund the acquisition of the assets? That is a financing decision that they are making. Right? And also what level of dividends should be paid to the shareholders? That is a payout decision. So they are just different ways of saying the same questions. Remember, investment, financing, and payout. Okay, so three important decisions. So what are the goals of the financial management? Okay. So later on in this unit and in any finance unit, you are going to hear that again and again, that the goal is to maximize the shareholders' value. Okay? So to maximize the shareholders' value or to maximize the shareholders' wealth. So that's the goal of corporate finance. So we are trying to maximize the shareholders' wealth. And here we are trying to understand, is it the same to say that maximizing the shareholders' value is the same as maximizing the profit of the firm? Are they the same or are they different? Because normally we would think that we should maximize the profit, right? Because you may think that they are related. Yes, they are related, but they are not the same. Okay? So we are trying to maximize the shareholders' value. And now I'm going to tell you the difference between maximizing profit and maximizing shareholders' value. This is one example that we found online, and it's just an example to show you that profit maximization is probably a short-term goal, but it's not the long-term goal that we are looking at. Okay? So if you are looking at different comments from the suppliers to the supermarkets in Australia, so here we are looking at Aldi, Coles, and Woolworths, and the suppliers complained that Coles and Woolworths reduced the supplier prices and took an extra 3% to cover marketing cost. Okay? So if you are the suppliers to the supermarket, to Coles and Woolworths in that case, you would not be happy, right? Because they reduced the price. So basically, they asked the suppliers to reduce the price, and of course that price reduction will be used to cover the marketing cost, right? So the suppliers will not be happy. However, if you look at the way that they look at Aldi, Aldi pays the invoice faster. And remember, when you pay the invoice faster, it means that you can't hold that money from the supplier that long. So basically, let's say, if I'm the supplier, okay, and you are the supermarket, so let's say that I'm the farmer and I'm giving you all of the farming products that I have, right? And basically, the supermarkets will have 3 months to pay me back. So the sooner that you pay me, the happier I am. I get the money earlier, right? And of course, the sooner that you pay me, you will take the cost. Because you pay me earlier, you cannot get the money invested from that. So if you keep that for 3 months, at least you can put into the bank. You can generate some interest. Agree? But if you pay me that, it means that you lose the opportunity to use my fund for that 3 months. So by paying me as the supplier a bit earlier, I'm, as the supplier, happy, right? And that's why they say, because it pays invoice faster and it is easier to deal with. So they seem to be really happy with the way Aldi is dealing with the supplier, whereas they complain about Coles and Woolworths, okay? But of course, you would know that Coles and Woolworths would have more bargaining power than Aldi. So they can do this. But then we just want to raise the question here that whether it is a good thing just to focus on profit maximization, okay? So the answer would be maybe in the short term, it's fine. But in the long term, it may influence or it may have a bad impact on the reputation. So it's just a question that we raise, but of course we are not saying whether it is correct to do that, to do this or that. We just put a question here for you to think about, okay? Put a situation and you think about that. Okay. So let me continue to tell you the difference between profit maximization and maximizing shareholders' wealth. How are they different? Okay. So the first difference lies on timing of return. Okay, this is the first difference between profit maximization and shareholders' wealth maximization. Let me give you an example. Assuming that I promise to give you $10, okay? And I ask you whether you want your money now or in a week. Okay. How many of you want the $10 now? Can you just ask? If you have two options, and I said to you that I'm giving you $10, you can choose whether you want to take that $10 now, or you can take that $10 in a week. Okay? You will take it now, right? I believe that most of you would say now. Why is it? What is the reason that you want to take that now? Time value of money, yes. So I make that simple example. With $10 now, maybe you can go and you can buy 4 sushi. Okay? Make that straightforward. And then in about a week, maybe that $10 can only worth 3 sushi. Right? You don't know whether the price is going up or down, but the chances is going up. So of course, you just want the $10 now so you can realize it. You can make it for sushi rather than waiting. So that's the first thing. And that's exactly what we're saying here, time value of money. The $1 today, what's more than $1 in the future? And that's the reason why everyone just wants the money now, not in the future. And if we come back to the example earlier with the supplier, we say that if the supermarket decided to pay it now, right, it means that they pay more than if they just delay the payment into the future. So in terms of time value of money, they are actually paying less. Okay? So that's one reason. There is another reason that we are looking at when I give you the options of getting the money now or in the future. The second reason that people are thinking of would be, what happened if I change my mind in a week? Right? Or what happened if I don't have the ability to give you $10? Even if I don't change my mind, I just don't have the money to pay you. So that's the risk associated to that week as well. So you'd rather realize it now, okay? But of course, if I give you another option, you get $10 now, or you get $12 in a week. Now it depends, right? It depends on each of your investment. So if you're thinking, maybe $12 in a week can buy more than 4 sushi, maybe you take that in a week. That's a simple way of saying. But in fact, we will say that is your opportunity cost. That's your other investment. It's not sushi, right? But it's just one example, analogy that I make here. So coming back to our story here with the timing of returns. If you are the financial manager and you want to maximize the profit, and you know that with the firm, they are looking at a year income statement and balance sheet, right? So maybe the financial manager would not care about whether the profit was made in the first month or in the last month of the year, because at the end of the year is the total profit. So the accounting profit does not take into account the timing of returns. Whereas we all agree that $1 today worth more than $1 in the future. So the profit maximization ignores the time value of money. Okay, so that's the first one. So with the second thing that we are looking at, it is the cash flow. Okay, that's the second difference between maximizing profits and maximizing wealth. That's the cash flow. So let's say that if you sell, you are an Apple company, and you sold the iPad to me, okay? And let's say that I'm the distributor. I take maybe 1,000 iPad, okay? And then I say, okay, sell the 1,000 iPad to me, and I'm going to pay you back in 3 months. So if I'm paying you back in 3 months, in terms of profit maximization, did you recognize the revenue from the day that we signed the contract? Or you recognize the revenue when I pay you the money? When we sign the contract, right? So basically, when the sale is made, that is when the revenue is recognized, not when the money is paid. They are two different things, right? That's why you have accounts receivable, because it's your asset, but then you have to collect that in the future. Agree? So in terms of revenue, it is from the day that the sale is made. But in terms of cash flow, the sale is made is not the same as the cash is paid. They are two different things. So in finance, we care about cash flow, not profit, because cash flow is really what you can use to make investment. If you want to go and buy the stocks, if you want to go and buy the shares, if you want to pay the salary to the employees, you have to use cash, right? It's not a record on the book. And that's why finance cares about cash flow. So here, profit is not the same as cash flow. And there is another thing that you need to be thinking of. It is the risk. That's the third one, the third difference between maximizing profits and maximizing shareholders' wealth. So if you are thinking of the two firms, and they are trying to maximize their profits, so at the end of the day, if our goal is to look at the profit, you may just compare the profits of the two firms to make an investment, right? If the firm is making $100 compared to the other firm, which is making $200, you are going to invest in the second firm, assuming that they have the same asset, they have the same total asset, right? You're going to invest into the firm with a higher profit because that's the profit maximization goal. But you are not sure whether the firm that makes $200 profit is taking less risk or high risk. Okay? And if it is the case, profit maximization just ignores the risk as well. And if you're thinking about accounting rules, so basically people can be subject to one set of accounting rules, and then they can record a bit more profit this year, right? And then in the future, it's going to affect the firm in the long run. And in that case, the firm is becoming less profitable in the long run. So maybe this year, that firm is making lots of profit. It is very short term, lots of profit. But if the reputation is damaged in the long term, it's going to be less profitable. So if you are the shareholders of the firm, you would not be happy with just 1 year high profit, right? You want it to be sustainable. And that's why we need to care about the risks of the firm as well. Of course, some people tell me that it depends on your investment horizon. If you are a short-term investor, you may care about short-term future of the firm. But if you are a long-term investor, you may care about longer-term investment. But remember that when you sell your shares, the value of the share or the price of the share will depend on the future performance of the firm as well, not only short-term performance. So we are going to look at how we value the shares next week, but basically you should understand that we need to care about the long-term performance or the long-run performance of the firm, not just 1 year performance. And in order to do that, we need to take into account the risk. Okay, so profit maximization ignores the risk of the firm, whereas we need to care about the risk. So that's the difference between maximizing profit and maximizing wealth. So remember that there will be timing of returns, cash flows, and risk that maximizing profit did not take into account. And it is just another example to tell you that maximizing profit may result in a lower profit in the future. Okay. So now we understand the goals of financial management. The next concept that I would like to discuss with you is the agency problem. Okay? So this is a very popular concept that you will hear again and again in different units in finance. So we are talking about agency problem all the time. So before I explain to you what it is, just start with agency relationship. Okay? So we need to understand what is agency relationship before we go further. I think something wrong with this. I'm not sure whether I can write. Okay. So if you are thinking about agency relationship, assuming that you have lots of money, okay? You have lots of money and you are thinking of opening a restaurant. You want to open a restaurant and you want to invest your money into the restaurant. But because you are doing full-time study and you don't want to spend your time in managing the restaurant that you're having, so what you are going to do is you are going to hire a manager, okay? So in that relationship, you are the principal. The manager of your restaurant is the agent, okay? When you hire someone to act on your behalf, to work on your business, they become an agent, and you become a principal, okay? So that's why it is called principal-agent relationship. And when you hire a manager, you would like them to act on your benefit. That's what you would expect, right? And they would have to do the best for your restaurant. Try to get more customers, generate more revenue and more profit. So that's what you expected. But then the question would be, can you guarantee that they are going to do this? Maybe not, right? So assuming that you are going to pay your manager $2,000 per month, no matter whether they make lots of profit or no profit, they are going to get $2,000 per month. What do you think about the manager? They do not need to work very, very hard, right? Because they would get $2,000 no matter what. There is no incentive for them to generate more return or more profit for your restaurant. Because even if your restaurant is making $1 million a month, they would only get $2,000. Agree? So here we are saying that when your agent is not acting the best or is putting his own benefit prior to your benefit, it is when we are having agency problem. So let me give a clear example for you. So assuming that you are going to hire that manager for a month only. So this is a month contract, okay? And you say that if you are making profit, you are going to receive 10% of the profit, okay? And of course, in this case, the manager will work really hard to make as much money that he can in a month. Because he's only working for you for a month. So he only has the incentive to work for you for a month and to generate the high income in a month, right? But even in that case, you are not sure whether having the high profit in a month is going to be sustainable or not. Or he's going to do something to help to boost the profit in a month, and then right after that month, it's going to be low. And it will affect your restaurant's profit in the long run. So basically, what we are saying here is that when the managers place their personal goals ahead of the corporate goals, we are about to experience agency issues or agency problems. Okay. And how to make sure that, how to mitigate the agency problem. And what we need to do is we need to align the manager's goals with the owner's goal. The only way to make sure that there is no agency problem, or at least you can limit some of the agency problem, is to align the two parties' interests, right? And how to do this? Just one example for you here. So Walt Disney Corporation provided its CEO with a remuneration package that had 3 components. So here there are 3 components of the package. A base salary of $750,000, a bonus annually, an annual bonus of 2% the net income, and a 10-year option. So let's analyze that package. Hopefully it's working now. So we have a base salary of $750,000. It means that the CEO will receive that base salary no matter what is happening, right? And then there is an annual bonus of 2% of company net income above a threshold. So what they are saying is, if a threshold of normal profitability is $200 million, for example, as soon as the manager can make more than that, he is going to get 2% of that every year. Of course, it is incentive for the manager to generate higher net income, right, or higher profit every year. And in order for him to make a long-term commitment to the firm, not a short-term, because we are saying that they may just look at the short-term profitability, not the long-term. So the firm is offering 10-year option that allowed the CEO to purchase 2 million shares of $14 per share. Okay. So what is share option? So assuming that you are the CEO of this company, you are the CEO, and you are given that 10-year option. So it means that in the 10 year, you are given the option to buy 2 million shares for $14 per share. So assuming that in 10 years, the share price is $20, would you be happy with that package? Yes, right? Because you can easily buy and pay $14 per share, and you can sell to the market at $20 per share. So you are making $6 per share. You will be happy. So you will work as hard as you could to be able to increase the share price. Because if the share price is high, you are going to earn more and more and more. Agree? So if the share price is $10 in 10 years, what is going to happen? You don't have to buy, right? You can just walk away. As the CEO, you are not committed to buy that shares. But as I said to you, if you are given that option, you would like to get the money out of that option. You just don't want to just to walk away, right? So you need to work hard to be able to boost the share price in the future. The higher the share price, the more profit that you are going to get as the CE, right? So here that package focuses on both short-term investment or short-term performance of the firm and long-term performance as well, right? So if you want to mitigate the agency problem, you should think of how to align your agent interest and your self-interest. As long as the two are aligned, and then basically the agency problem will be less and less. Okay. So the last part of the corporate finance section that we are looking at is the financial markets. Okay. So what is financial market? So before we are looking at the financial market, just think about that as any market. So what are the components of any market that you can think of? You need the buyer. You need the seller. And you need the venue. And you need the products, right? Basically, you need the products, you need the buyers and sellers. And of course, the definition of venue now is a bit wide. Because basically, you may need a physical venue, but you may not need a physical venue with the development of technology, right? But it's a virtual venue. So here we are looking at the buyer, the seller, and the products. So why is it called financial markets? Because the products are financial assets. That's very straightforward, right? So we need the buyer, we need the seller, and we need the products, and here we need the financial assets or financial products. Okay? And if you look at this here, securities are a general term to call financial assets or financial products. Can we just list some of the financial products that you know? Can I just get just one example in each of the row of the class? Any products that you can think of? Can I get the first row? Anyone just say something? Options. Okay. Okay, the second row? At least you need to know one thing, right? Shares. Thank you. What else? Oh. Bonds. What else? Interest. Interest rate. You say? Okay. What else? Financial asset. Yeah, foreign currency. What else? Swaps, thank you. Keep going. Insurance contract. Someone just said CDS, right? So basically, if I give you an hour, it would list 200, 300, 400 of the products, right? Okay, so what I'm saying here is that if you want to think of different products that can be traded in the market, we can just combine them into the group. Let's say that we have debt instruments, okay? So what would be the components of debt instruments? We have bonds, long-term debt instrument. We have note, medium-term debt instrument. We have bill, short-term debt instruments. And of course, regarding to bond, bill, and notes, we would have treasury bond when the issuer is the treasurer, right? And we would have corporate bonds, right, when the issuer is a corporation. So you can actually break it down into the issuer, you can break it down into the group of the asset. And then if you're looking at the shares, we have common share, we have preferred shares as well, right? And then we are looking at derivatives where you have options, futures, swaps, and we have foreign currencies. So basically, we are going to look at them, some of them not into details, many of them in details, but some of them not into details in the future topic. Okay? Okay, so if you want to classify the financial markets, we can use different criteria. So there will be different criteria to classify the financial market. That is one criteria. We have primary market and secondary market. So what is primary market? Primary market is a market where the original sale of debt and equity securities takes place. So basically, here we are looking at the markets where the securities were first issued. Okay? So the transactions will be done between the firm or the issuer and the investor. So if my firm A, issued either bonds or shares to the investor, so the investor get the securities and pay back the money. Okay? So this is called primary market. That is when the securities were first issued. Okay? So let's say that you were among those investors. You bought the shares when my firm issued. Okay? What is the maturity of the shares, by the way? Is there a maturity for a share? No, right? As long as the firm exists, the share will be valid. So here there is no maturity at all. So what I'm saying is that you bought the shares as the investor. You bought the shares when my firm issued the shares to you. Would you be committed to hold the shares forever? No, right? You can just sell the shares whenever you need the liquidity, whenever you need the money. So assuming that you need the money, you sell the shares to your friends. Is it going to affect my firm in terms of the balance sheet? No, right? It's your transaction with your counterparties. It has nothing to do with my firm. And that's why it is a secondary market. So secondary market is when we talk about the transactions between investors. And it is not going to affect the issuer. Whereas the primary market is when the securities were first issued. Is it clear? Okay. So that's our first criteria. You can also break the financial markets down into two types. You have money market and you have capital market. So money market will be short-term, and capital market is trading long-term securities. Okay? So when we are saying long-term securities, we are basically talking about bonds and shares. Bonds will be long-term debts, and shares will be long-term as well, right? And other financial markets include foreign exchange markets and derivatives markets. So we are going to look at those markets in week 12. Okay, so what are the functions of financial markets and intermediaries? So the first thing that we are looking at is the central bank, or in Australia, the Reserve Bank of Australia can use the financial market to stabilize the economy by avoiding high inflation. Okay. So can I just ask you, So we all know that in order to stabilize the economy or to avoid high inflation, the central bank should do something to affect the money supply, right? When the money supply increases, inflation will increase or decrease. If we have higher money supply, so more money in the economy, more cash in the economy, what do you think? Higher inflation rate, right? Because we need more money to be able to buy the same good. Make sense? So inflation rate will increase. So of course, if the RBI realized that the inflation rate at the moment is too high, higher than the 3% target, it would like to reduce the inflation rate by lowering the money supply. Agree? So in order to lower the inflation rate, we need to lower the money supply. How to do that? To buy or to sell the securities. How to get back the money in circulation? To sell the securities, right? So by selling the securities, they are going to collect the money, and those money will be kept and not be circulated. And that's the way to lower the inflation rate, right? So basically, via the transaction in the financial markets, the RBI can adjust the inflation rate. And that activity is called open market operation, okay? Open market operations, OMO. So that's one of the activities that the central bank can do. Okay. So now we are going to look at the details of different functions of the financial markets. So it's going to be very intuitive for you. So I'm not going to spend lots of time on this. So the first one is to transport cash across town. If you are the investors, you have lots of money, you have lots of savings, right? You can determine to not to consume today, just to invest. So in the future, you will realize your investment, and then you can consume in the future. So that's the way you can transfer your savings from today to the future. Make sense? Because if you have $1 million today, and you are thinking that you are not going to use $1 million today, you may need to use it when you retire, right? So what you are doing is you are going to make an investment today. And by doing so, you are not eligible to use that $1 million today anymore. But you can use it in the future when your investment is realized. And then you are going to spend your money in the future. So that's the way you can move your savings from today into the future point in time. Okay? And that's also the way that the economy can help to transfer the savings from one party to another party. So basically, someone in surplus today can have the one in deficit today. So in the future, the one in deficit can repay back. Okay? So that's the first function. The second function is risk transfer and diversification. Okay? So with risk transfer and diversification, let's give an example then. I always want you to remember the three important concepts in finance. So that's the three basic concepts that we are going to look at. The first one is time value of money. Okay? The second one is arbitrage. So arbitrage is the way that we use to be able to price any financial asset. And the third one is diversification. So you will hear the term diversification or don't put all eggs into one basket. You must have heard that before, right? So we want to diversify. Okay? So assuming that you have $1,000 today, and you understand that you need to diversify, you go to the stock market, and you want to invest, and you say, I would like to invest into 20 different stocks. Put $1,000. Is it feasible? Maybe not. because you know that if you go to the stock market, there will be a limit of every order will be at least a block of 10 stocks. And if the stock price is $20 per stock, basically you don't have enough money to diversify your portfolio, right? Even though you know that you need to diversify your portfolio, but you are a small investor, you have no chance to diversify. So how the financial markets can help you? So that's an example of mutual funds. So basically, the mutual fund can issue the shares as the equity, and they will invest into a diversified portfolio on the asset. Are you with me? So this is a mutual fund. So their assets are a diversified portfolio, and they issue the shares. So as the small investor, you don't have the money to invest into each of the share here. You don't have the money to invest into each of the share on the asset side here, right? But if you can just buy the share of the mutual fund, it is an indirect way of buying a diversified portfolio. Is it clear? So if you are thinking of this, you invest into my firm, okay? And my only asset is the mouse. So indirectly, you are investing to the mouse, right? So it's the same here. You invest into the mutual funds, but that mutual fund is holding a diversified portfolio. So basically, you are having a diversified portfolio. Or if you want to make it more intuitive, let's say that the total asset here is 100, and they issue 10 shares, okay? So each share will be 10% of the diversified portfolio. So if you don't have the money to buy the whole portfolio, you can simply buy one share. So you can buy 10% of the diversified portfolio. So it's the same way as diversifying your portfolio, isn't it? Okay. So that's the second function of the financial market. The third function is liquidity. So we mentioned earlier that you invested your money into the shares or the bonds, and when you need the cash, you can simply go to the market and sell your shares or your bonds. And that's the way that you generate liquidity. Okay? So just want to add one more thing about liquidity. So when we are talking about liquidity in the financial market, make sure that you understand there will be two components. The first one is the ability to convert into cash quickly. Okay? That's one component of liquidity. We need to convert the asset into cash quickly. The second thing is you need to convert into cash at a lower cost. Okay? Let me give you one more example. If you have a mortgage, a house, your house worth $1 million, do you think the house is liquid? No, right? If you want to convert the house into cash quickly, you can. But then you have to sell the house for $100,000 instead of $1 million, right? If the house is $1 million, then you advertise to sell it for $100,000. I believe that you can sell it in a day, right? Even in an hour. But then it's not liquid because you have to bear a large loss. So that's why we are looking at two things. You have to convert into cash quickly and at a lower cost. So here we are saying that the financial markets give you a facility to convert your investment into cash quickly with a lower cost. Okay? The fourth function is the payment mechanism, and this one is familiar to all of you. And thanks to the financial institutions, we can do the payments very easily via credit card or BPay, so you know different payment system, right? And finally, that's the informational efficiency or market efficiency. So here we are saying that because of the financial markets, all information is included into the share price. Okay? So the share price would reflect all of the relevant information. So we are going to talk about market efficiency in the future. But at least what we are saying is that If you know that the company is good, that good information should be reflected into the share price. So the share price should be high to reflect that it is a good investment. Does it make sense? So that's sort of the market efficiency that we are looking at. So I'm going to give you, let's take 10-minute break. So we get back at 25 to 11. Okay? Okay. Okay. I think we should continue. And the second part of the lecture is going to be more on calculation. So I think you will have more time to practice and discuss. So the first one is heavier on theory, so you were listening to me. And this one, I give you more chance to work on your own problem. So basically, we are going to look at basic concepts of financial math. Okay? So let me emphasize that it is very, very important topic. And the reason is because if you miss the concept for this lecture, you will find it very hard to follow the next couple of lectures because they are built on each other. Okay? So if you can't follow me or if you don't understand straight away in the class, you practice it at home and you seek my help straight away for this topic. Okay? Because later on, it's going to build up on the concept that I'm going to talk in a few minutes. So if you miss it, you would miss the next 2 or 3 lectures. And I don't think that is a wise decision, right? So if you have any question at all, let me know straight away. Okay. So for this part of the lecture, we are trying to understand the time value of money. The concept is simple. $1 today works differently from $1 tomorrow, right? And we are looking at the simple end compound interest. And we are learning how to calculate the present value and the future value of different types of cash flows. Okay. And finally, we look at inflation and time value of money, and we are calculating effective annual rate. Okay. So this is the concept, time value of money. And as I mentioned to you, it is the foundation concept. So we need to know what is time value of money, what is arbitrage, what is diversification. So those 3 concepts are key in finance. Okay. So for today's lecture, it's not really important to identify whether it is inflow or outflow. But later on, I'm going to explain to you, in every cash flow that you are drawing, you need to make it really clear whether it is an inflow or outflow. Only for today's lecture, we are learning the basic concept, so the inflow and outflow is not a big deal. But from next week, we are going to focus more on cash inflow and outflow, and that's why I put it up there. So you need to know, you need to identify clearly whether the cash flow that we are looking at is an inflow or an outflow. Okay? And you should know that interest rate is measured in percentage. I think that's straightforward, right? It is used when the agreement is in the form of debt. Okay, simple interest and compound interest. So before we look at the definition, I give you an example first, and then we are going to look at the definition. Let's say that you want to invest $100 today, okay? So today is time 0. So make sure that you build the habit or you develop the habit of drawing the timeline. It's going to help you a lot with a more complicated question. So for time 0 today, you want to invest $100, okay? And I ask you how much you are going to receive at the end of year 2. So in year 2, how much you are going to receive? That's the question. You invest $100 today, how much you are going to receive in 2 years' time, okay? And because you are going to look at the value in 2 years' time, when you know the value today, okay, you need to calculate something in the future, and that's why we are using future value calculation. Because we know the value of the cash flow today, we need to work out the value of the cash flow in the future, and that's why we are using future value formula. But then, before I give you the formula, just work on it together. Assuming that our interest rate is 10%, Okay? Assuming that the interest rate is 10%. So what would be the value of our investment in a year? What do you think? In a year, you are going to earn back 100 times 10%, right? Everyone would know that, even if you don't learn finance. You put your money into the bank, and then you would know that at the end of the year, you should get 110. Agree? But remember, we don't need the money at the end of year 1. We need our money at the end of year 2. So that 110 here becomes our principal, right? So remember, in the first year, 100 is our principal, and we make $10, and that's why at the end of year 1, we have 110. So if I want to calculate the value in year 2, what would it be? 110 times 1 plus 10%, right? And it's 121. Are you with me? Okay, so if you're thinking about the formula, 110 is actually your 100 times 1 plus 10%, right? I just break it back. So it is 100 times 1 plus 10%, and that's the 110 here. And then I put that back in here, so it is to the power of 2. Something wrong with that drawing, so just bear with me. Okay, so it becomes 100 times 1 plus 10% to the power of 2. So you are clear with that, right? So my next question would be, we get the total value after 2 years of 121, okay? And that 121 includes 100, that's how much we invest at the beginning. Agree? So let me call that principal. And that principal happens to be at time 0, so it is your present value, because it is at time 0. At time 0, $100 is $100, right? So it is the same as present value. With me? And then the $20 is actually your principal times the interest rate and times 2 years, right? So if you want, just put N here. And it becomes 100 times 10% times 2 years, right? And this one is called simple interest. This one is called simple interest. So what is simple interest? So simple interest is the interest that we earn on our principal, right? That's the definition up there. Simple interest is an interest that we earned on the original principal. So what is that $1? Because remember, at the end of year 2, we have 121. So we have that $1 here. Do you know how is it generated? From the interest that we earn after the first year. So if you think about that, right? At the end of the first year, we actually earn $10 interest, right? And then we reinvest that interest for another year. And we earn 10% of that. So it's 10% of that $10 interest becomes $1. So that $1 here is the interest that we earn from investing our interest that we made in the first year. It is called interest on interest. Okay, that $1 is called interest on interest because it is the interest that we earned on the interest that we made after the first year. Clear? Is it clear for you? Okay, so what is compound interest? It's the total of the two here. It's the $21. So compound interest is the total interest that we earned, both on the original principal and on the interest. And it is called compound interest. Okay? So in this case, the compound interest is 21. And it is including the simple interest and the interest on interest. Okay? Are you with me on this? Okay, let me give you two options. Assuming that this is one option that I give you, the interest is calculated every year, and you are the depositor, and I'm the bank, and I say to you that I'm going to calculate your interest every year, and that's how much we get, right? I give you another option. I say, if you want, I can calculate your interest every month. What would you prefer? Monthly or yearly? Monthly, right? Why would you prefer monthly? Higher compounding interest, because you would generate interest and you reinvest that interest. So that's why you will have more interest on interest, even though the simple interest is the same in both scenarios that I give you, right? But you will earn more interest on interest in the monthly option rather than the annual option. Does it make sense? Okay? So that's why we need to care about the compounding frequency. So here our compounding frequency is yearly. But of course, as the investor, as quicker or as higher the frequency is, better it is for you, right? So let me show you how to do that in your financial calculator. So we start with a very simple one, and then we are going to build it up to make it more complicated, okay? Oh. This one is very blur. Very blur, okay? So it's clearer here in my screen, but I don't think you can see it. Is it better here? I think it's very blur here, but I'm going to be very slow. So just see whether we can do that together, okay? I need to see the question back in here. Okay. So before you do anything, make sure that you clear the memory. That should be your habit, because we don't want to leave any previous setting. So when you clear, we have an orange ship down button. Can you see the one? That's an orange one up here. Okay, the orange ship down button here. Okay, that's the one. Can you see it? So this one and then the one underneath with a letter C will help you to clear the memory. Okay, when you press it and click C and see what number will appear, okay? In my case, the number is 1 per year. I do that again and you can see. It's 1 per year. Can you see that? If you don't have 1 per year, you have to reset it. Is it 1 per year or is it 12 per year in your case? 12, okay? So the way to reset is as follows. So the 12 per year would be equivalent to that function, the fourth one from the left here. Next to PV, you have the PMT, and underneath there is P/YR. Can you see it? So we have to change it to 1 per year. So the way to do that is you have to choose the orange function, right? And that's why you have to put the orange ship down button first and click that PMT. And now you put 1. Okay? Let me do that again. Okay. Did it work? Now is it 1 per year now? Can you try that again? Because we need that function to be 1 per year. If it is 12 per year, it's going to be wrong. So put it 1 per year. Let me try that again. That's all I do. Okay? Just put 1, and then you shift, and then PY, and then it should be 1 per year. Have you all got it? Try to clear it again to see whether it's 1 per year. If it is, it's right. Has anyone not got what I just said? Is it good now? No? Okay, I change to 12 per year then, and then show you again. Okay, you see when I shift it down, it becomes 12 per year now, right? Can you see that 12 now? And I said that is not correct. You have to put it back 1. The way to do that is put 1, okay, shift down, and then put that PMT 1. That's it. And then now when you try to clear it again, it will become 1 per year. All good? Okay. So now, what we are doing is we want to calculate the future value. What we are using would be the top 5 buttons on your calculator. Okay, so now we just input 1 by 1. What is the value of n? 2. So 2, press n. You put the number first, and then you put the function. Okay? So n is equal to 2. What is your interest? 10%, right? The only thing that you need to remember here is that with your financial calculator, the percentage is default in that function interest here. So when you put 10%, just put 10. Okay, that's only true with that interest function. Because by default, interest rate is in percentage. So instead of putting 10%, we put 10 interest. Make sense? What is our PV? 100, thank you. All right, 100, and then press PV. The PMT at the moment, because you haven't learned, so I'm not going to talk about that, but then we are going to look at that in the annuity section. So the PMT is the same as ordinary annuity. In this example, we don't have any other cash flow rather than that 100, right? So the PMT is 0. Okay? Because other than the $100 cash flow, we don't have any extra cash flow, do we? And that's why we just put 100, and then PV, PMT will be 0. And because we need to calculate FV, press FV. Did you see the number here? Very easy, right? Can you see that? Can you do that? Okay, so people ask me, why is it minus? And come back here, and then I explain to you in the drawing form. Okay. Have you all got it yet? If you haven't, there will be a next example for you, so just stop by now, okay? Stop now. So what is happening in your calculator is this. I know that you're going to get more excited when you are doing the calculation, right? Just hold your excitement for a minute. I said to you that you will have plenty of time to talk, right? So let me go through the important parts before you can do a practice. I'm not going to stop you from doing that, but not for now. So remember, we start with a value of 100. I just don't know what's going on with that drawing thing. It doesn't follow what I draw. Okay. So we start with a value of 100. I wish I would give you the whole hour to do this, right? But not now. Okay. If you start with a value of $100, the calculator would think that we start with a positive 100. It's the same as an inflow. So it means that you will play the role of the bank or the depositor. Do you reckon? Who will get the money at time zero? The bank or the depositor? The bank, right? The depositor put the money to the bank. So for the depositor, it is an outflow because it is the money coming out of the depositor's pocket. It is the money that is coming into the bank's budget. And that's why if you are standing from the point of view of the bank now, you have that positive 100 at time zero. In time two, what is happening? The bank is paying. Agree? The bank is paying back the money to the depositor. And that's why the money at time two should be an outflow, not an inflow. And that's why if you put that $100 as positive in your calculator, when you press that FV function, you will see a negative value to show you that it is an outflow. Okay? But if you put that negative 100 in your calculator, you would get the 121 in a positive value. Okay, so for our purpose, because we just need to know what is the equivalent future value and present value, that's why I said to you that the inflow and outflow for our first lecture is not really important. But later on, when you have more cash flows, some cash inflows, some cash outflows, it's very important for you to be paying attention to each of the signs. Okay? So for now, you can just simply ignore this. Ignore the negative and positive. Does it make sense? Okay. So this is another example for you. Calculate A's repayment of a loan of $100 after 5 years. So here we are talking about a loan repayment. So they borrow at time zero and they pay back in 5 years. So as I mentioned to you, you would tend to go and do that straight away with your calculator. But then I ask you not to do so. Just start with the timeline. Build that as a habit before you do your financial calculator. Okay? So very easy. At time zero, there will be a $100. $100. And they ask you what it is, what would be the future value of this in 5 years. Very straightforward here, right? If you plug it in, you would get the value of 161.05. Okay? So is it all good up to here? So if you look at the payment schedule here, okay, so we start with the value at the beginning. It is $100. We all know that, right? And based on our calculation, the value at the end is 161.05. We can do that easily. And out of that, how much is the simple interest? How many years? 5 years. And each year we earn $10. So 50 is our simple interest. $100 is our principal. The rest should be from our interest on interest. Okay? So this one is not hard for you to work out. So if you are looking at the chart, you can see that every year, the simple interest is growing up by the same amount of $10. The simple interest that the bank earns every year is $10, right? And that's why you see that every year is increasing by $10 compared to the previous year, right? The same amount, $10 every year. The difference is the interest on interest. And you see that the longer the maturity, the more interest on interest that the bank is earning. right? It's very intuitive. The longer the maturity, the more interest on interest that the bank is earning. So you see that there is that green one, that green bar here is getting bigger and bigger over time, not at the same amount. So it's increasing more and more over time, whereas the simple interest is increasing at the same amount every year. Okay? And it is very simple to think about that. We accumulate interest every year, and that's why the amount of interest that we generate from the interest we made will be more and more over time, right? And that's why you see the green one is bigger and bigger over time. And here, it's just to show you the future value of $1. So if you look at here, the future value of $1, and we have the formula as follows. I think I can show you here. Okay? So if you look at the formula of the future value is equivalent to the present value times 1 plus I to the power of n. So if you have a higher interest, your FV will be higher. If you have a higher maturity, your FV will be higher. It's very intuitive from your formula, right? Nothing's different here. Nothing is very difficult for you to understand. Okay? So just based on this one, FV is equal to PV times 1 plus I to the power of n. So one thing I would like you to remember, we've been doing that with yearly or annual interest. So assuming that I change my question, I say to you that calculate A's repayment of a loan of 100 here. After 5 years, interest at 10% per year, compounded quarterly. Okay? So it is not yearly compounded anymore. It is quarterly compounded. What should we do? What do you think? So just do this. Our PV is equal to 100. How about our interest? 10% per annum. And it is equivalent to 2.5% per quarter, right? So you have to convert everything into that frequency, compounding frequency. So you have the interest. How about the number of years? N is equal to 5 years. And it is equal to 20 quarters, right? So when you plug into your formula, you should use those numbers. So PV times 1 plus 2.5% to the power of 20. Can you guess whether the number is bigger or smaller than 161.05? Bigger, right? It's going to be bigger because it's compounded more frequently. Make sense? So it is a process that you need to follow, no matter whether you do that manually or you're going to use your financial calculator. So look at the compounding frequency. And then if it is quarter, you have to convert every single thing into quarter. Okay, all good? Okay, the next one. Assuming that now we know the future value, and they ask you what would be the present value. For example, you want to save $100,000 to buy a car, a sport car, in 4 years. How much should you put into the bank today? Right? That's an example of present value calculation. So in order to calculate the present value, it's straightforward. You just use your future value formula and you rearrange the formula to get the present value one. So PV is equal to FV divided by 1 plus I to the power of n. Right? That is straightforward from the formula here. We just rearrange it. Okay? So when we calculate the present value, it is called a discount process. Because basically, we are discounting our future value cash flow back to our present value, right? So this is a discounting process. So can you go to that website? Respond.cc. You can use your smartphone, any smartphone or laptop or iPad. Just go to respond.cc to see whether you can do this question. Okay. By the way, just to let you know that this is an anonymous website. So basically, don't worry about your identity. I just want to show, to see how well you are in terms of understand the lecture notes. Okay? So don't worry. Whatever you know, you plug it in. So you go to respond.cc, and you are required to put in the session key. And the session key is 483233. Well, I can't write it. 683233, question 1. It's supposed to be question 1. I don't know why it was clicked on question 3. Okay, I give you another 2 minutes to do that again. No wonder it takes you that long. It's my mistake. 683233. I give you another 20 seconds, and we should finish. Okay, I think we stop. going to close the session, so when you're at home, you would not be able to access that anymore. But it's not important. You have the question in front of you now, right? So just look at the question together and see whether you got it correctly or not. So a car dealer gives you the choice to pay $15.5 thousand cash now, or make 3 payments, $8,000 now, $4,000 at the end of each of the following 2 years. If your cost of money is 8%, what do you prefer? So here we have 2 options, and you want to compare the value of the 2. And because you are the person who makes the payment, you would choose the option with the lower value, because it means that you are going to pay less. Agree? And in fact, you can convert them into both future value or present value. It doesn't matter, as long as you compare the 2 options at the same point in time. You can compare both of them using their present value. You can compare both of them using their future value. In this case, you should use present value, simply because the first option has already been given as present value, right? And that's why you don't want to do another conversion. So let's look at how we've done. So out of 22 responses that I've received so far, 16 of you got it correctly. So the answer would be the second option, as the present value of the second option is 15,133. So at least the majority is correct, so that's good, okay? But in the next question, I would like you to attempt a bit more, because 22 with the size of our class is a bit small, right? So we get back to our question now and see how we do it. As I mentioned to you, just draw the timeline. So for the first option, the present value is given. It is 15,500. There is no need for any calculation. For the second option, there will be $8,000 now, $4,000 in a year, and $4,000 . There is a setting problem with this calculator, okay? So $4,000 in the second year. So your job is calculate the PV of the second option. How do we do that? You need to calculate the present value of this $8,000. You need to calculate the present value of the $4,000 here and this, and sum them together, right? So how about the first one? The present value of the $8,000 is still $8,000, because it occurs at time 0, right? So it is $8,000. If you still want to apply your formula, you can do that. You divide it by 1 plus H% to the power of 0, because your maturity is 0. So you know that even if you plug your formula in, you get the same answer of $8,000. And you plus $4,000 here, divided by 1 plus H% to the power of 1, plus $4,000 divided by 1 plus H% to the power of 2. And the answer would be 15,133.059. Okay? That's the answer. So if you want to use your financial calculator, how can you do that? There will be a slow way where you just need to put 5 the present value of the $4,000 in 1 year, as what we've been doing, and write it down, and then 5 the present value of the $4,000 in the second year, right? Can you say again? That's the question, right? Plus the 4,000 in 1 year and plus another 4,000 in the second year. And $4,000 at the end of the following 2 years. So I mean, okay. So basically here I should be clearer, each of the following 2 years. Okay. And that's why we draw the timeline like this. So each of the following 2 years. Okay? Okay, everything's good? Okay. So we should choose the second option because we only need to pay 15,133. The next part of the lecture is on annuity. So what is annuity? An annuity is a series of cash flows of equal amount, equally spaced in time, over a finite period of time. So there will be 3 criteria, remember. They will have exactly the same cash flow every period, okay? Exactly the same cash flow every period. And those periods are equally spaced in time. It can be every month, every quarter, every half a year, every year. And then we should know the maturity or the horizon. So we should know whether it is 5 years or 10 years or 20 years. It should not be infinite. Okay. So there are 4 types of annuity. The first one is ordinary annuity. Okay. So let's have a look. So with the ordinary annuity, you see that it is an annuity because we have the same cash flow every period. Okay? So don't think about that as every year, every period. So the same cash flow as every period, and we have n cash flow in total. Okay? And also, if you look at this here, our first cash flow occurs at the end of the first period. Okay? So our first cash flow occurs at the end of the first period. So there is nothing at time 0. The first one will occur at time 1. It is a pattern of ordinary annuity. Okay? So why do we need to care about ordinary annuity? If I ask you to calculate the present value of those cash flow, and I give you all of the information regarding what is the value of C, what is the value of N, can you do your calculation? You can simply calculate the present value of each of them, right? And sum them together. Assuming that I give you N is equal to 100. You would not like to do that, right? Because you don't want to do 100 calculations and sum them up. So what we are trying to do here is, mathematically, there is a shortcut for you. Instead of calculating the present value of each of the cash flows, now we can use one simple formula, and you can calculate the present value of everything. Okay? So instead of doing PV is equal to the present value of this, right? So it is C divided by 1 plus I to the power of 1, plus the present value of this, and it means that plus C divided by 1 plus I to the power of 2, and you keep doing the same thing up to C to the divided by 1 plus I to the power of N, right? So if we don't want to do this, everything here is the same as this formula. Okay? So the sum of all of those cash flow is the same as the formula here. If you are interested in how to derive it, you can try at home and then you can bring it to me. But I don't expect you to remember that. As long as you understand that instead of doing one by one, we can actually use that formula because it is an ordinary annuity. Okay? So how to Just do one example and see whether we can use our financial calculator to do this. Find the present value of an ordinary annuity of $5,000 for 4 years at 8% per year. As I said to you, draw a timeline first. Here we have how many years? 4 years, right? So 1, 2, 3, and 4. And how many cash flows? Will be 4 cash flow. The first cash flow will be at the end of term 1, because it is ordinary annuity. So you know that the first cash flow will be 5,000 here, because it's the same cash flow. So we have the second one will be also 5,000, 5,000, and 5,000. Right? That's the cash flow. And if you want to calculate the present value, it is equivalent to, if you come back to the formula here, you just plug it back, right? So it is 5,000, your C, divided by your interest, 8%, times 1 minus 1 over 1 plus 8% to the power of 4. So instead of doing 1 by 1, you can just combine them, and you should get the answer of 16,560.63. Okay? Okay, all good? So if you want to use your financial calculator, how should we do this? I'm not going to turn the document camera on, but I'm going to tell you the steps one by one. So can you turn on your financial calculator and clear the memory? When you clear the memory, remember to put the orange sheet down and the clear on button. Okay, so you clear that? So now what we are going to do is we are going to use the top 5 buttons again. What is our N? 4 years, right? You put 4 and then you click N. Got it? What would be our interest? 8%, but we only input 8. We need to find PV, so we don't do anything with PV for now, right? What is our PMT? PMT is our ordinary annuity. And now we put 5,000 PMT. Is there any extra cash flow other than that ordinary annuity? No, and that's why our FV would be 0. And when you hit PV, you should get the answer of 16,560.63. Got it? Have you all got it? Okay. So just remember that our PMT is exactly our ordinary annuity here. Okay? So PMT is the ordinary annuity that we've been talking about. The second type of annuity is the annuity due. And if you are looking at the pattern of the annuity due, can you see the difference now? Instead of making payment at the end of the period, we are having payment at the beginning of the period. And that's why our first cash flow is at time 0. Okay? So if you look at the number of cash flow here, we are still having N cash flow in total, right? we are still having n cash flow in total. And our first cash flow occurs at the beginning of the period. So our first cash flow occurs at the beginning of period 1, at the end of period 0. Our second cash flow occurs at the beginning of period 2 or at the end of period 1. So remember, when we put that cash flow on top, it means at the end of that period. So at the end of period 0 is the same as at the beginning of period 1. Right? So we have n periods in total, and all of the cash flows are met at the beginning of the period. Okay, do you understand the difference between the two now? So how can we calculate the present value of the annuity due? I give you a suggestion. If you are thinking about that, the whole cash flow that we are having here, you can break it down into two parts. That one should be calculated separately because it happens at time 0. The present value of C is C, right? How about the one from here to here? What do you think? What is it? That's the ordinary annuity, right? So this is an ordinary annuity of how many cash flows? N-1 cash flow. And that's why we just simply apply the ordinary annuity of N-1 cash flow here. So if I ask you to calculate the similar question, but now it is annuity due, what should you do? You can simply do that with the 3 years first, and then you add back the one at time 0. Okay? So the formula looks a bit complicated, but it's not. So you can simply use the ordinary annuity formula, and then you can calculate the present value of all of the other annuity types. Okay? So we break it down into two. So for this question, I'm going to save time, so I'm not going to ask you to go to respond.cc again. We can do that together. Okay? ABC has been promised 7 monthly payments, okay, of $1,000, with the first one to occur immediately. So as I mentioned to you, just draw a timeline. So here we have 7 payments, 7 months. And because we start today, so what would be the time of our last payment? 6 or 7? 6, right? So you have $1,000 here and $1,000 in 1 month, and you would have that here up to month 6. Right? Calculate the PV of the annuity if the interest is 0.5% per month. So you can just apply the formula PV is equal to 1,000, because we need to break that down into 2, right? So $1,000 here plus 1,000 divided by 0.5%, and 1 minus 1 over 1 plus 0.5% to the power of 6. That's correct, 6 cash flow. And the answer would be 68. Can you just spell it out? 68? 96? 38, right? That's 38. Okay? So how can you do that with your financial calculator? So this one I'm going to slow down and tell you. Okay? Why is it so blur? But at least you can see it. Okay. So again, we turn it on. We clear the memory. It's our habit. What is N? How many years? 6 years, right? Remember, we look at our term here, we have the last one would be in 6 months, the end of month 6. So n is equal to 6. What would be the interest rate? 0.5%, but we don't input percent, so we just put 0.5 interest. Is there any cash flow at time 0? Yes. So this one, it is not a part of the ordinary annuity. You can input that into your PV, right? Because it is separate from your ordinary annuity. And it is $1,000. So 1,000 PV. Or maybe just ignore that because later on we have to calculate that. So I just don't want to mix it up. Just leave it there. So just don't put anything with PV. PMT is equal to 1,000. FV, 0, right? And you would get PV of minus 5,896. And remember, we ignore that minus sign. And now we need to add back the $1,000 at time 0. So it will become 6,896. Okay? Because we need to calculate the present value, I'm not going to mix it up. So that's why I'm not going to put that 1,000 in. Otherwise, we can't do the job here. So is it easy? Is it straightforward? Okay. So now we are going back to our next part, next type of annuity. Okay, the next type of annuity is deferred annuity. It is an annuity, and the first cash flow occurs sometime in the future. Everything's good? So in order to calculate the present value of this, how should we do? Again, we think about those cash flow as an ordinary annuity, right? Because remember, the ordinary annuity will have the first cash flow that will be occurring at the end of the first period. So if I ask you to calculate the PV at time K, this cash flow becomes ordinary annuity, doesn't it? Right? So if you can apply the formula of the ordinary annuity to get PVK, you just need to discount it back to PV0 to get the ordinary, to get the present value of those deferred cash flows. And that's why if you look at those formula, this part will tell you the PVK. And after you times 1 over 1 plus I to the power of K, you get the present value of the whole cash flow pattern. Does it make sense? So the 1 from C over I and the bracket, that is to help you to calculate the present value of all of the cash flow at time K. And you just need to know how many cash flow it is. So it should be N minus K minus 1 plus 1. So it is N minus K cash flow, right? And then you can apply the formula. When you get PVK, you need to discount by K periods to be able to get PV0. Everything's good? Okay, so I don't want you to remember the formula. I want you to know, as long as you understand the ordinary annuity formula, you should be able to calculate the present value of the annuity due and the present value of the deferred annuity, just based on the ordinary annuity formula. Okay? This is the last type of annuity. We have the growing annuity. So with the growing annuity, it is a little bit different. We don't have the same cash flow every period anymore. We have our cash flow that is growing at a G percentage every period. Okay? So you see that at the end of the first period, it is C. At the end of the second period, it is growing by G percentage. So it is C times 1 plus G. In the next one would be C times 1 plus G to the power of 2. And you keep doing that. So this is the cash flow. Okay? And if you observe that pattern, you would have the present value equal to that following formula. Okay? So instead of doing one by one, there is a mathematical way for you to have a shortcut, as long as you can identify correctly the pattern. Okay? Okay, so we know how to calculate the present value. The next one would be how to calculate the future value of those annuities. So if you think about that, the present value of an ordinary annuity is equal to C over I times 1 minus 1 over 1 plus I to the power of n. This is our formula. So if we need to calculate the future value, what would it be? So future value is our present value times 1 plus I to the power of n. You agree? So we term both of our left-hand side and our right-hand side by 1 plus I to the power of n. So what we get would be C over I. 1 times 1 plus I to the power of n is 1 plus I to the power of n, right? And minus 1. Because if you term that by 1 plus I to the power of n, this one will become 1, and this one will become 1 plus I to the power of n, doesn't it? So you can obtain the future value formula easily. Okay? So with the future value of the ordinary annuity, it is very easy for you. How about the future value of the other types of annuity? In order to calculate that, again, we need to go through 2 steps. In the first step, you are applying the present value formula to get the present value of those annuities. Okay? It's the same as what I just explained to you. You use the ordinary annuity formula, and then you can work out the derivation of the present value for any other type of annuities. And after you can calculate the present value, you can simply times 1 plus I to the power of n, and you can work out the future value of those annuities. Okay? So there will be 2 steps for you. In the first step, we get the present value first. Okay? If they ask you to calculate the future value, start with the present value formula. And after we can work out the present value, we can simply times 1 plus I to the power of n to calculate the future value. Is it clear? Okay, can we do that question together here? ABC can save $200 per month, but intends to start saving today. So we have the same question that we got earlier, right? You draw the timeline. The first payment would be $200 today. And the last one would be in terms, how many months? 2 years' time? 23, right? Agree? The last one would be 23. And in the middle, you have the same cash flow. So $200 per month. And they ask you, what is the FV in 2 years' time? So they ask you, what would be the FV in month 24? Right? So how to do this question? You get the present value of those cash flow first. So you get the present value at time 0 first. After you get the present value, you calculate the future value at time 24. Okay? Let me give you the solution here. So I give you the solution. You can just go home and see whether you can get the number, okay? So in order to get the future value in the first step, you need to get the present value, and it is 4,435.152. And in the second step, FV24 is equal to 5,243.4339. Okay? Is the concept clear to you? Get the present value first, because we do have the present value formula for those. And after we get the present value, we calculate the future value by timing by 1 plus I to the power of n. Okay, so now we understand the annuity. The next part of the lecture is on perpetuity. So what is perpetuity? If you look at the ordinary perpetuity, you see that the only difference between perpetuity and annuity is the maturity. So if you want to calculate the present value of the annuity, we do need to know what is the time period. And that's why you have the number of period is equal to n. If it is perpetuity, that cash flow will be repeated forever. Okay? And it is true with consolidated bond. When you are entitled, as the investor, you are entitled to receive a coupon of the same amount infinitely. Okay? So here you receive the same cash flow every period forever. And that's the definition of perpetuity. So with perpetuity, the present value is equal to C over I. That's very easy, right? The cash flow divided by the interest rate. With the growing perpetuity, it is similar to growing annuity, but then it's growing forever. That's all, right? It's going to be infinite number. And just remember that the present value is the cash flow at the end of the first period. It's very important that you know that we use the cash flow at the end of the first period. Because later on, many people mix up between whether they use the next cash flow or this cash flow or the previous cash flow. So our formula is applicable using the cash flow at the end of the first period. So PV is equal to C divided by I minus G. So I is your discount rate and G is your growth rate. Okay. So the formula is much simpler than the annuity one, right? So the last part of the lecture is on inflation and time value of money. Okay? So here we are talking about how inflation can affect your calculation of present value and future value. Okay? So you have the formula here. This is called Fisher effect. So this formula is nothing, has nothing for me to explain. I'm not going through the details of this. What I'm trying to tell you is that the quoted interest rate includes two components. So let's say that if you put your money to the bank and the bank promises to pay you 5%, that 5% is nominal rate or is real rate? Nominal rate. So if they promise to pay you 5%, and if the inflation rate is 10%, as the depositors, would you be happy? No, right? Because you have a negative real rate. So you know that the inflation will affect your real rate. And the nominal rate is how much or is what they quote in the market. So why is it important for us to know about inflation? So if you are thinking about the way that we've been doing, a simple way we say present value is future value divided by 1 plus I to the power of n. Right? That's our formula. So what I'm trying to tell you here is that if you are using the real discount rate, you have to use the real future value. It should be consistent. So if you are saying, I need to invest or I need to save $100,000 to buy a car in 4 years, in nominal term, right, you need to use your nominal discount rate. But if you say that I don't know about the inflation in 4 years, but I need to save $100,000 real term, you need to discount using your real discount rate. So the numerator and the denominator should be consistent. So we will have more examples for you in the future to know that better. But at least we understand that inflation will affect our rate. And it will guide us in terms of whether we use the nominal or the real cash flow in our numerator. Okay? Okay, so our final one would be on the effective annual rate. So with the effective annual rate, it's very simple if you think about that. You put your money in the bank, and the bank is quoted an interest rate of 5% per annum. Okay, that's how much they quote. Would you be happy if they calculate the rate every month or every year? Every month or every year? That's the same question that I asked earlier. Every month, right? Why would you be happier if they calculate it every month? Because they receive more, right? Because you will receive more. If they calculate it every month, you will receive more interest on interest. Agree? So if you receive more, it means that the effective annual rate, when your interest rate is compounded monthly, is higher than the interest rate when it is compounded yearly. Okay? And in order to compare the two options that I've just given you, they are using effective annual rate. Okay? And the calculation is straightforward. Let's say that if you put $100, you just want to calculate the rate that you return, right? You invest $100, and they pay you interest rate of 12%, and they calculate it monthly. What would be your equivalent interest rate? You put $100, and if you are using your future value formula, right, and it's equal to 1 year, if you are using your future value formula, your future value is equal to 100 times 1. 1 plus, just bear with me, I don't think I can change it anymore. So 100 times 1 plus, what is the interest rate? 1% per month, right? How do you know it is 1%? It's 12% divided by 12 months to the power of 12. That's how much you receive. How much did you invest at the beginning? 100. So in order to calculate the return, you should take whatever you receive minus whatever you invest. Wow, it's going to be really messy here, right? Whatever you receive minus whatever you invest, and you divide it by what you invest, right? So that $100 can just be ignored, agree? and you just put, it becomes 1 here. So that's the formula that we get here, if you think about that. 1, I ignore it, so that we don't have anything here. The 1 in the bracket is 1 plus K is your quoted interest, which is 12%. M is the frequent or the compound frequency per year. In this case, it is 12 times per year, and that's why we divide by 12. And to the power of 12, how many times that we compound every year is 12, and we minus 1. Right? It is straightforward for you to understand how we calculate the effective annual rate. And then there is an example for you to calculate at home. But from the bank's point of view, which one do you prefer? The annually, right? Because you pay less to the depositor. Of course, if the bank is the lender, they would prefer the daily one, so that they can collect more from the borrower. Right? So you can try to calculate that at home. Okay? So I give you all of the example here. Just try to do that at home. And if there is any question, you come to see me during my consult. Okay? So I see you next week.